Alright, for this video I'd like to review a book. The book is Deep Freeze, Iceland's Economic Collapse by David Howden and Philip Vegas. Uh, I've been interested in Iceland for a long time and in Austrian economics for even longer, so this book seemed like the obvious fit. And why I think this book is important is that with the onset of the financial crisis worldwide in 2008, um, there's kind of been a battle of ideas uh, as to its cause, with you know a large number of people alleging that the financial crisis is the result of deregulation, of unrestrained capitalism, and that it demonstrates a greater need for government intervention into the market. And on the other side, there are those who I would say correctly point out that we don't have a free market economy, that we have enormous intervention into the economy from the government, and that those government interventions are indeed the cause, at least the primary cause, of the economic downturn. Now, this book does not address the entire world economy. What it does do is examine the specific situation in Iceland, and that is a good place to do it because Iceland, although very small, is basically a microcosm, and what happened there was similar in kind, if not in scale, to what's happened elsewhere. So the book just goes through a timeline of the collapse, of its causes, and traces the governmental policies, and not just the Icelandic government, but world government organizations like the IMF, and then just other governments around the world, and how their policies played a role in precipitating this collapse and exacerbating it. And I think that that's a very important theme. And like I said, rather than attempt to make that argument for the entire world, they just focus right on Iceland. And of course, it's claimed many times Iceland, because of some of its politicians' supposed free market principles, and some very limited deregulation that occurred, is seen by many as a very clear example of the failure of free markets and of the necessity of government intervention. And yet, clearly, as the book points out, Iceland did not have a free market economy. Like most countries, in fact, probably like all countries today, in some, well, in quite a few, but in some major areas, it has an extremely high degree of government intervention. This, of course, includes the financial sector and monetary policy. And I think that this is kind of epitomized by a famous debate held in Reykjavik in 1984 between Milton Friedman and three socialist intellectuals from Iceland. And I think it's emblematic because although Milton Friedman certainly had his merits, he has become essentially the epitome of free markets to many people. And although that is the case in many areas, he had many failings when it comes to this. He was an interventionist when it comes to monetary policy. And this is significant. It's because it is those interventions, in part, although not in whole, which actually cause all these problems. And so it's true that the longtime Prime Minister of Iceland, who then became the President of the Central Bank, David Ovesen, is an explicit admirer of Friedman and free markets and Ronald Reagan and Margaret Thatcher. It should be noted that that ideology is not consistently free market, and that the areas where it is not, the areas where it is basically socialist, where it is pro-government, those are the areas from which the problems in Iceland have sprung. And so They go into many, many causes, and I don't know how appropriate it is to label one or another as the main or the only cause. Um, Broadly speaking, one of the main ones is the moral hazard. Moral hazard, of course, being when uh, the losses or risks uh, a market participant faces are mitigated or eliminated by a government promise to cover those losses. That, of course, incentivizes people to be very risky. There's nothing wrong with risk, but if you should lose out on if you should lose out on a risk, you should be the one that has to pay for that. And if you are told that you won't need to do that, then you're liable to take more risks than you otherwise would. In any event, there were both implicit and explicit guarantees given in the case of Iceland. Uh, when its major financial banks were denationalized, um, the Central Bank of Iceland, which is still completely a part of the government, this is as distinct from, say, the Federal Reserve, which is quasi-private. Uh, it's certainly not free market, but it's not technically part of the government. And in the case of Iceland, the Central Bank of Iceland is technically part of the government. And the Central Bank of Iceland back in 2001, David Ovesen again here, the Friedmanite, Reagan, Thatcher free market man, explicitly guaranteed uh, the solvency of the main financial banks. There is also an implicit guarantee from the IMF, which had bailed out many other countries before. And then, to a lesser extent, there is also the implicit guarantee of sympathetic other countries, like Norway or Denmark, Sweden, the UK, perhaps the US or the Netherlands. So that moral hazard is definitely one of the main reasons. Another one of the big factors is um, the misallocation of resources that typically accompanies credit expansion. Now, Iceland is not alone in nations that engage in credit expansion. Pretty much they all do now to one degree or another. And the problem is that this causes malinvestments. The classic example is put forward by von Mises is a builder who plans on building a home. He bases his assessment of what he's going to build on his estimate of the resources that are available, and he begins construction of a home. And halfway through, he realizes that there are actually fewer resources than he had originally thought, and that the home, as he started to build it, cannot be completed, which means he has wasted, he's wasted time and effort and resources. He may be able to salvage something, but there definitely has been a loss. Now, in the case of Iceland, this did occur, but it occurred in such a way that the malinvestments were greater than the basically entire assets of the entire nation. The liabilities of the three banks exceeded the gross domestic product by several times. At one point, they go through the I think he said that they exceeded the reserves of the central bank by like 32 times or some outrageous margin like that. And this was largely caused by a false sense of the resources available. And so what the Icelandic financial banks engaged in was a process whereby they would borrow money in the short run and invest it in long-term investments. And these long-term investments would pay very high dividends, higher interest rates, higher rates of return than the loans that they were borrowing to finance them. However, these projects wouldn't mature for many years in some cases. And although it may be true that they would have been productive enterprises, if you don't have the resources to complete them, then you're squandering your finite resources that you do have. And so what ended up happening was the three main financial banks in Iceland um, ended up not being able to meet their short-term liabilities, and this was made doubly worse by the fact that they had incurred many short-term liabilities that were denominated in foreign currencies. And this meant that the explicit guarantee of the Icelandic central bank was of little to no value, because the Icelandic central bank, though it can print as many krona as it wants, cannot print euro or yen or Swiss francs or dollars. Then the perfect storm, which really made it bad, was then the implicit guarantee of the IMF and other nations also did not pan out, because Iceland was not the only country having a hard time at this point, and so none of the other countries were really interested in I mean, they were bailing themselves out. They didn't feel that they had time to do so for Iceland. So a massive, massive financial collapse occurred. And the book is very important in that it outlines exactly how the government policies encouraged this collapse. I don't think you could say they make it inevitable, but they incentivize it to happen. When you create moral hazard, then you are, I mean, they point out, it's plausible a banker could have said, well, you know, there's credit expansion going on. There aren't really this many resources. We should save more and, you know, maintain higher reserve ratios. That if they did that, they wouldn't be able to offer the higher quality services or lower prices in the short term, which means they would have lost customers and business to their more opportunistic, though less prudent competitors, who are in effect getting a subsidy from the government in the form of a promise to bail out any malinvestments they may incur. So had there been, or were there prudent individual institutions, they almost certainly would have gone out of business, or started to go out of business and then had to have changed their ways to take advantage of the rampant speculation that was going on. So definitely a worthwhile study. Anyone who reads this book will know more about the collapse in Iceland than anybody they are ever going to meet, and they will know full well that it was precisely the degree to which Iceland did not accept free market principles that its crisis has occurred.